front of you, not the end of the world. So who am I? I am Calvin Loy, clearly. These are my two emails. You can feel free to email either one. You can take that down, shoot me an email the entire term, I guess the entire term being the entire month, really. And I'll try to get back to you within 24 business hours. Usually I respond faster than that because I am a pretty boring person. I have nothing to do but accounting, so I am pretty responsive, in my opinion. What else was I going to say? If you haven't noticed already, I do like to go off on a lot of tangents. I promise I eventually do come back. But if I go too far off, feel free to message in the chat to put me back in the right direction. Before every lab and during every lab, I like to highlight kind of the important concepts that we'll be focusing on that lab, because I feel like if I just jump right into a question, without kind of giving you kind of the information beforehand, you might not remember it, and me solving the question in front of you without you knowing what I'm talking about is not very helpful. So I do like to give a very quick review, which you will see as we go through the labs. By no means is this exhaustive of everything you need to know, but I think it'll definitely help with that lab. I guess if you haven't already, I suggest you screenshot this here, and I will often give you opportunities to screenshot. I recognize that sometimes I talk too fast, and you might not be able to copy everything down. If at any point you need me to go back to anything, again, feel free to message in the chat. I have no problem doing that. So a very basic intro to accounting. What I've always found very difficult is introducing accounting. For someone who's already taken accounting, you'll probably find this course relatively simple, but for someone who has never been exposed to accounting whatsoever, I have been told it is a challenge to begin. And it's very hard for me too to explain intro accounting, because I know assets, liabilities, and equities like no tomorrow, I feel like at this point, because that's all I've ever talked about for 4 years. Again, very boring person, right? So if I'm keeping things very, very, very simple, asset, something that you own, liability, something you owe, equity is the net worth, is what I call it. So remember, our fundamental accounting equation is assets equals liabilities plus shareholders' equity. This equation always has to be in balance. So if I think about it from me, just look at me, don't think about a company, just think of me for now, or think of yourselves. Assets, these are things that I own. I might have a checking account, I might have a savings account at a bank, I might buy TFSAs, RRSPs, I might own a car in my name. Those are the assets that I own. So that's going to be A. But I'm going to subtract the liabilities from it. Liabilities being things like my MasterCard bill, the loan that I have on my car to pay for my car, my Visa bill, things like that. Those are my liabilities. That difference is my own equity. That's how much I'm worth if I was to put a value. Obviously, we as human beings are priceless individuals, do not get me wrong. But from a financial perspective, what I own, assets, minus what I owe, liabilities, that's kind of that net worth there in a financial perspective. And so if I add the liability back to the other side, that's how I get that assets equals liabilities plus shareholders' equity. That's where this equation comes from. So this is what we'll be looking at for corporations, of course, not for humans, for people. So that's kind of the very solid foundation that we need for the course, or for these problems anyways, that we'll be solving today. If an asset or liability is what we call current, we would expect that it would be used. If it's an asset, it would be used, and if it's a liability, it would be paid off in less than a year. So this might be the cash in our wallet. This might be our Visa bill. We expect to use the cash in our wallet or pay off the Visa bill within a year. That's a reasonable assumption that we make. An asset or liability is non-current or long-term if we expect that the asset will be used or the liability will be paid off beyond a year. So if I own a house is my long-term asset. I'm not expecting to use up the house within a year. And a long-term liability might be a car loan. For example, if you finance your car over 5 years, that's a long-term liability. Again, if at any point I'm not making sense, message in the chat. Okay, guys? Revenues. Revenues are a recurring stream of income. That's again a very basic, like a very basic definition. And expenses are any recurring costs that are used to generate that income. So if I own Club Monaco, income would be the shirts and pants that I sell. Expenses, the recurring costs used to generate that revenue. I have to pay my employees. I have to pay the rent space, which in Polo Park would probably cost a ton of money. I have to pay maybe insurance and things like that. And so revenue minus expenses gets you a net income. If revenue is more than expenses, you have a net income. If revenue is less than expenses, you have a net loss. Obviously, we'd want a net income over a net loss. Okay. I'm going to continue scrolling then. All right. So feel free to take a screenshot of this. Obviously, if you can copy it down in time, it would definitely make much more sense to copy it down in time. This will be very important. These things that I've created for you, these charts or notes, if you will be important as we solve the questions. So an introduction to debits and credits. So you've heard of these words before, hopefully. You might have a debit card and a credit card. How I like to explain debits and credits is by looking at a T account. So in a T account, which I'm highlighting now with my cursor, the left side is what we call the debit side, and the right side is what we call the credit side. Now, don't get confused with, positive being the debit side and negative being the credit side, because that's not necessarily the case. I have separated our assets, liabilities, and shareholders' equity equation right here. So if I just look at my assets T account, assets go up on the debit side and assets go down on the credit side. So this you could probably think of like a bank account, right? When you put money into your debit card, your checking account, it will go up here. And when you use that money to pay off your credit card, your asset would go down. So it's on the credit side. There is numerous ways to think about this and wrap this around your head. Hopefully I'm conveying the message, or hopefully you have found your own way to wrap this around your head. That's assets. Liabilities and shareholders' equities, on the other hand, will behave the same. They both go down on the debit side and they both go up on the credit side. If you recall, and I'm going to type it right here, our accounting equation, assets equals liabilities plus shareholders' equity. You see that assets behaves one way on the one side and liabilities have the opposite behavior on the other side of the equation. Remember, this equation must always stay in balance. And here it said, recall that the difference between revenues and expenses results in a net income or loss. Ooh. It says my voice is buffering. Not sure if it's just me. Okay. Does anyone else, can everyone else hear me good? Okay. So maybe, okay, it's better now. Okay, thanks guys. Wow, you guys are very responsive. I absolutely love this. If only I could see you all in person, that would be kind of the best scenario. But I've always been told that if anything, I talk very, very loudly and you all have to turn down the volume on your tablet or computer to about halfway. That's what I've been told. I guess that's a good problem to have. Okay, so recall that the differences between revenues and expenses results in a net income or net loss. This net income or net loss goes to, this is obviously not like I'm physically going somewhere. It goes to an account called retained earnings. So shareholders' equities for right now in the course, as of this moment right now, and I say this because it gets more complex, at this moment right now, you need to know that shareholders' equity comprises of two accounts, common shares and retained earnings. The net income or net loss goes to this account called retained earnings. We want to measure net income or net loss over a period of time, right? We track it. Typically for a company, that's 1 year. At the end of the year, we come up with a number that might be a net income or a net loss, but it needs to go from our income statement, and again, revenues and expenses are on our income statement, to the balance sheet, our statement of financial position, and we do that through retained earnings. If that's confusing right now, don't worry. We'll have a few more run-throughs of it as we solve the questions. But just know that we have to close our revenue and expense accounts into this account called retained earnings. Retained earnings is a permanent account, right? Because if you make money over the course of the year, that money will not vanish overnight on December 31st into January 1st, right? That money that you made should exist somewhere. And so it has to exist in retained earnings. That's the permanent account. Okay, so as a result, when revenues go up, we credit. When revenues go down, we debit. When expenses go up, we debit. And when expenses go down, we credit. So this is where it can get confusing. So I said that net income or net loss goes to retained earnings, which is a shareholder's equity account. Revenues, okay, they have a positive effect on net income, right? The more revenues you have, if you have zero expenses, you'll have more net income. So revenue will play into net income, which goes to retained earnings, which is the shareholder's equity account. So I'm going to go to the shareholder's equity T account. So when revenues go up, net income goes up, retained earnings goes up, so shareholders' equities goes up. So when revenues go up, shareholders' equity goes up, so we credit that entry. So it's a credit balance. When revenues go down, the opposite is true, so we have to make a debit entry. When expenses go up, now expenses, they take away from our revenues, right? So if we have a lot of expenses, that reduces our net income. So retained earnings will shrink, right? Shareholders' equity will go down. And so when we have more expenses, when expenses go up, shareholders' equity will go down. So that is a debit side entry. And the reverse is true when we credit. So like I said, if this is not making sense right now, we'll do some questions and hopefully it'll be a little bit more clear, but I want to give you kind of this foundation first before we tackle into it. I realize you probably all just learned this yesterday from 6 to 9:45 p.m., which was your first class. So it might still be sinking in. So I realize that. In summary, so you can see that I have a note here. Your proper classification of your accounts becomes so important because whatever you classify your account as, that affects whatever journal entries that you need to make to establish the financial position of your company. So if something's an asset and you call it a liability, well, you have a problem because if that asset went up, if it was an asset, if you labeled it an asset and it is an asset, and that asset went up, you would have a debit entry, which we abbreviate as DR. I don't know if I've mentioned that yet. But if you label it as a liability and you said it went up, all of a sudden that's a credit entry. Now that's a mistake, right? If it was an asset, it would have gone up on the debit side, but you labeled it as a liability, so you have it on the credit side, or CR for abbreviation. So that's a problem. Here is a very, very quick summary. You make a debit entry when assets go up, liabilities go down, shareholders' equity goes down, revenue goes down, and expenses go up. You make a credit entry when assets go down, liabilities go up, shareholders' equity goes up, revenue go up, and expenses go down. So if you know this little summary here that I've crafted for you, the only real concern that you need to have is, are you classifying the accounts correctly to make a proper journal entry? Does anyone have any questions at this point? If not, I'm going to go tackle a problem. And of course, I'll be reiterating this. I hope you all got to copy this or screenshot this or whatever mechanism you so choose to get this information down. Because it'd be great to refer back to this as we solve the questions. Okay, so I see no comments in the chat. So I'm going to move along then. Again, if you have a problem or a question or a concern or you need me to repeat, let me know sooner rather than later. Perfect. Beautiful. So Alex here, I have a question, clarifying question from last night's lecture. Is there a preferred method of preparing financial statements, handwritten or Excel? So most companies nowadays, so Alex, I'm assuming you're talking about like the real world. Now, please correct me if I'm wrong. The real world, we very rarely do handwritten financial statements. Everything's is now computerized. Um, and it's all in some accounting software. So we very rarely write out financial statements anymore. If you were taking this course during a non-COVID-19 time, you would be expected to handwrite, all those financial statements on paper on an exam booklet. However, because we're in COVID times, we are in kind of an Excel situation here. And so I will be doing them on Excel. On your midterm and final, do not quote me on this, but on your midterm and final, I assume that you will be writing the exam in Learn under the Respondus lockdown browser. So you'll be doing that electronically as well. But in very brief, Alex, the preferred method nowadays of preparing financial statements is electronically via an accounting software. So you might have heard of QuickBooks. That's a common one for a lot of small businesses. At my work, we use SAP, which is an enterprise resource planning system. It's an ERP system. And there's many others that can do that. So thank you to kind of your classmates for answering that. R is for revenue, E is for expenses. You will find that I will use a ton of these abbreviations very frequently. So if you don't know what they are, by all means, be sure to ask. So A is assets, L is liabilities, S is shareholders' equities, R is revenue, and E is expenses. Okay. So our first problem is problem 271B, the accounting cycle. This is on page 122 of your textbook, if you have it in front of you. If not, it is on the screen right here. So Sweetwater Temporary Clerical Help Service opened for business in June 2018. From the opening until the end of the year, Sweetwater engaged in the activities described below. So that a realistic trial balance can be prepared, the events described below are aggregations of many individual events. So you have the events A through I. You need to analyze the effect on the basic accounting equation. What that means is it an asset, liability, shareholder equity, revenue, or expense account? And is it going up or down? And you need to prepare the journal entries. So these are your debits and credits. Hopefully last night in yesterday's class, you got to see some entries. I imagine you would have, otherwise this lab would make no sense. So that is what we're going to tackle here today. So I'm going to combine requirement 1 and 2 all together because I just don't want to go through A through I and analyze and then go all through A through I again to prepare the journal entries. These problems are not available on Learn. They're in your textbook. So I have a question here. They're in your textbook, but the questions that we will be doing are in a lab schedule on Learn. So you will need a textbook or your ebook if that's the option you purchased. I have it here on the screen to kind of go over the question because I can't really hold up the textbook and show you. I don't have a dot cam, unfortunately. So yeah. So A here, issue 10,000 common shares for $4.50 per share. So whenever I'm confused, if there's cash in the entry, I follow the cash. That's kind of the phrase I use because cash is very easy. You know cash is an asset. It's something you own. And if you follow kind of this template, if you increase in cash, it is a debit entry. If you decrease cash, it is a credit entry. And we, of course, know that the accounting equation has to be in balance. So then you know what the other side of the entry would be. So if I'm issuing these common shares, I'm issuing them for cash. Whenever we see issue common shares, it's issuing for cash unless otherwise stated. So I always know I have a debit entry and I have a credit entry. We always have a little bit of an indent for the credit entry. Follow the cash. I issued those common shares for cash. Cash is an asset that I own, so I'm going to put it in the debit line. And I'm going to go asset goes up. You do not need to write this asset goes up thing. I only do that because it hopefully helps you to see the transaction. It says, okay, do you know where I can find the recorded lectures? Where you join the WebEx. Yeah, I think so too. It's somewhere in WebEx where the lectures are recorded. I do not record the labs, just as the FYI to all of you, as you're all here. Okay, so credit. What did I issue? I issued common shares for those cash. Let's go back. I know that common shares is a part of shareholders' equity. I issued more shares. Shares went up. Shareholders' equity goes up. It goes up on the credit side. Common shares. Shareholders' equity goes up. Okay. See how the accounting equation is in balance here. If I would have said, if I said shareholders' equities goes down and I make another entry on the debit side, I now have two debit entries and no credit entries, and that makes no sense. What is the dollar amount? I issued, I believe it was 10,000 common shares at $4.50 a piece. So that is $45,000. Put commas here to try to distinguish that. Okay. B, purchased office equipment from Furniture Max for $18,710 cash. Like I said, when we're first beginning, follow the cash. If I purchased this equipment for cash, I had an outflow of cash. I had to spend cash. The asset went down. When the asset goes down, we make a credit entry. So I'm going to credit 18,710. Credit. Oops, remember to indent. Credit cash. Asset goes down. Oh, I'm going to have a hoot with copying and pasting these arrows. Let me tell you. 18,710. What did I spend that cash for? I spent it for office equipment. First of all, I know I have to make a debit entry. The reason I know that is because the accounting equation has to be in balance. My debits have to equal my credits. I can't make another credit entry. But let's just confirm, and that's the beauty of accounting. That is, if you know what you're doing, I guess. Let's just confirm that this makes sense. We spent this cash for office equipment. That's what the question told us. Office equipment, it's an asset. It's something that we own. It went up. I got more office equipment. So I should be making an entry on the debit side. What did we do? We made an entry on the debit side. That makes sense. C, received 112,880 from clients for services provided. If I'm providing services to clients, this is revenue. Now you might wonder, how do I know all this off the top of my head? When you do so many of these questions, it'll become second nature to you. When it says, we received money for providing a service, it's service revenue, and so on and so forth. For 112,800, I'm just going to key in those dollar values right now. Oops, 112,880. Okay. I have a question here. Can we write furniture, or we have to write office furniture only? Okay, so this is a very good question, Karnik. Labeling of accounts is going to be a mental battle in your head. What should I label that account? What should I call it? There's certain things you cannot label wrong. For example, cash is cash. Accounts receivable is accounts receivable. Common shares is common shares. You can't call it anything else. When we have office equipment, or vehicle or truck or car, things like that, it begins to get a little tricky. I always say, what does the question tell me? The question said office equipment. In order to, keep it simple and save my butt, so to speak, so that I don't get it wrong for labeling it wrong, I'm going to label exactly what the question told me. The question said office equipment, so I'm going to go office equipment. If you wrote equipment, would it be wrong? Probably not. In fact, I'm pretty sure it would not be wrong. If you wrote furniture, okay, now, is it really furniture? So then it becomes a little bit more of a challenge. So I always say the easiest thing is just to write what the question says. Does that answer your question, Karnik? Okay. It's also very hard to begin accounting because we're just tossing a bunch of these terms and accounts at you that you've really never seen before. So every question seems like this whole new whirlwind of an account. But I am confident that as you do more of these questions, it will become more clear. So we said this 112,880 was revenue. So I'm going to go to my little T accounts here, or my little notes down here. In fact, I'm just going to copy this actually into the question so I don't keep referring back to it. Revenue. Revenue went up. What do? I'm going to make that a credit entry. So again, indent that credit entry. I'm going to call it service revenue. This is revenue oopsies. This is revenue going up. Again, if the question doesn't explicitly ask you to analyze the effect of transactions, you don't need to show this asset up, asset down type of thing. I'm just showing you, hopefully it'll help you illustrate the point. Revenue goes up, we make the credit entry. What's the debit entry? Because again, debits always have to equal credits. I see your question, Tomer. I will get to you in one quick moment. I received this amount. I received it in cash. Very good, Vanshika. Cash. Again, these have to be equal, but let's check our work to see if it makes sense. Cash is an asset. We received it. Asset goes up. Here it says we debit. Oh, look at that. We actually are debiting. I kind of just checked my work. Very good. So there is a built-in kind of mechanism to check your work. It's not always foolproof, but it might be an option. Hey, Tomer, is there a reason you always do the debit first, then credit under? I don't think there's like a explicit rule for doing it in this order, but this is kind of the norm that we've created in accounting. That's what you do. The top should be your debits and the bottom should be your credits. Yeah. All I can say is it's a norm in accounting, and that's what we've always done, and that's what we'll keep doing. Navleen, one of the questions, there was a statement which said that the supplies purchased were used. We deducted it from the asset side, but why do we deduct it from the retained earnings side too? Can you tell me what question that was, Navleen? Was that in one of your like your notes from yesterday's class, or was that from today? I will let you type anything you need to see that you feel like you need to type. We will do a supplies question later on down here, so hopefully that'll help you clarify it too. D, paid wages of 87,300. Follow the cash, right? We paid wages. There was a cash outflow. Cash is an asset. Asset goes down, so we make that credit entry. Credit cash, asset goes down. For this amount of 87,300, we need to make a debit entry for the corresponding amount. What is it? Okay, so here is a very important debate here. So someone said wages. It is wages. We paid wages, but this is what we call wages expense. You need to distinguish between expense, or you need to show that it's an expense because it is not a liability. Oftentimes people get confused between expenses and liabilities. Why do I know this is an expense and not a liability? You might argue, well, wages, we had workers, we owe them this money for the hours that we worked. But liabilities is what we owe. Do we owe them these wages anymore? No, because we paid them, hence expense. Okay? So it's not a liability, it's an expense because we no longer owe it to them. It has already been paid out. So this is expense, and your expense is going, I could ever figure out how to easily copy this. Expense is going up, expense goes up, we make a debit entry that coincides with this rule as well. Okay, I'm trying to catch up here on the questions here. One of the recommended questions, I will send you the question number at the end of class. Perfect, that's very good, Navleen. Jazz says, hey, what is part 1 and part 2 of these questions? Yeah, so there were 2 questions asked initially. One was to analyze the effect on the accounting equation, and one was to make the journal entry. So the parts of the questions that I have here, like this, where it's like asset goes down and all that stuff, that is part part 1, that's analyzing, and making the entry itself is part 2. Anmol says, shouldn't there be an L with a downward arrow next to wages expense? No, because wages expense is an expense. We've paid it. We are no longer liable for it, right? A liability, it's something we're still liable for. If I've already paid my workers for this month, $87,300, I'm no longer liable for it. So it's no longer a liability. It's no longer something I owe to these employees. It's an expense because I've already paid it out. Well, you might think, oh, the expense has now gone down because we have, fulfilled our obligations to these employees. We've given them their salary, but the expenses are going up, right? We've accumulated more and more of these expenses, and that's why it's an expense going up and not a liability going down. Okay, I like your questions. E, we borrowed $20,000 from the Royal Bank on a 3-year note payable. So when we borrow money, what do we get in return? We get cash. I sound very, very materialistic because I'm like, I love cash, follow the cash, But we receive cash when we take money out of a bank. So we're going to debit cash. And so that is an asset going up. I hope you're seeing that cash is usually the easiest one to look at first. And then Chica says credit note payable. Do we agree? I do. Note payable. I see a question. I'll come back to that momentarily. Note payable. Payable is a liability, right? This is an obligation we still owe to the bank. It's something we owe. Would you say it's a long-term liability or a current liability? I pose that question to you all while I copy and paste this arrow. Long-term, that is correct. Very good. Again, this liability is going up because we've increased the amount of obligations. By how much? We increased our debt to the bank by $20,000 in return for cash. So I see a question here from Doolin. How do we know if it's paid by cash or by credit? Very good question. It should specify in the question. If it does not specify in the question, you can assume cash. So far we've seen received this amount, paid this amount. So we're assuming that's cash. If it said something like received this amount on account, then it would be an accounts receivable that we need to set up. Hopefully we'll see some of that shortly, and that'll clarify your question. F says that we paid office rent of $10,200. Follow the cash. What happened to the cash? Cash outflow. We had to pay it out. So we credit this. Asset. I should just start copying and pasting these. I feel like that might be a little bit easier, actually. Sorry if I'm a little rusty with this. My first time teaching in a couple months, so it's a little odd, I guess. And I've also not been doing much other than being in bed and lying down and watching TV and Netflix and Disney Plus all day long, so that doesn't help the cause either. I hope, or I wonder if some of you can relate. And here's me off on a tangent and not remembering what I was talking about. We paid rent expense. We paid rent expense by $10,200. Or sorry, it said we paid rent, and I'm telling you it's an expense because we no longer owe it once we've paid it off, right? This is an expense, it's an outflow of cash. We need to pay rent in order to earn revenue, right? I said that expenses have to be tied to earning revenue. And so this is expenses going up. And again, if I look here, expense goes up. We make a debit entry, and so we see that that relationship continues to hold true. Okay. I really hope I'm making sense, and that you are all gonna stop me if I am not. G and H. G. Purchase office supplies on credit. So to answer your question, Doolin, from earlier, it now is telling us on credit. So I purchased office supplies on credit for $21.20. We should not specify it as an office expense or as rent, can be for anything. I wouldn't call it an office expense, Venchika, because office, what is that office expense? Was it for, insurance for the office, so on and so forth? If I was a company that had a lot of renting, I could call it office rent expense to be more specific, that would totally be fine as well. Okay, G. Purchased office supplies on credit for 2120 from Office Supply Inc. So it's on credit. So whenever we hear on credit, that's kind of that accounts payable, accounts receivable. So you were hopefully introduced to that yesterday. For some of you, it might be a very new term. So it just means we haven't paid it yet. Sometimes when you're a company, you don't have to pay off your debts right away. They give you 30 days or something along those lines. And so when I purchase something on credit, I have what we call an accounts payable because it's an amount that I have to pay someone, right? I'm never receiving this money. I have to actually pay it out. So accounts payable is a current liability. So in this case, because we purchase office supplies, we have created ourselves a current liability called accounts payable. And this liability amount has gone up because we've created this obligation to pay someone the amount of 2120. If I look on the other side, what am I paying for? Office supplies. That's something I own. So that is an asset. When I purchase office supplies, I get more office supplies, right? So that asset goes up. Asset goes up. We make a debit entry. So I'm going to debit office supplies. Asset goes, I think I have the same thing copied. Beautiful. Asset goes up. Of course, if I was to walk through this like I just did, and I said office supplies went down and I have to make a credit entry, please do not make an entry to office supplies with a CR in front of it and call it a day, because your accounting equation no longer is in balance, right? Your debits have to equal your credits. You can't just have two amounts on either side that do not balance. So again, it's a way of checking your work. H. Paid $1,200 toward the payable established in transaction G. So paid, there's a cash outflow. Okay, follow the cash outflow. Cash is an asset. Asset went down right here. So I'm going to make a credit entry. Asset went down. Oopsies. Asset went down by $1,200. What did I pay that, or what did I use that cash to pay off? I paid it to reduce that payable, the account payable that I created in transaction G. That was for the office supplies. So remember, accounts payable was a liability because we owe someone this money. It's an obligation that we have. The reason I make a debit to accounts payable, one, again, the debits have to equal the credits. That's a fundamental. But also, this is a liability. When we pay it off, if you see my cursor, the liability is going down. So we make a debit entry. Liability, nope. Liability is going down. So I make that entry for $1,200. Now, Karnik here says for accounts payable, can't we write the name of the firm? So here's what I see to that. In accounting, a company will frequently have lots of accounts receivable and lots of accounts payable. They all get aggregated into one accounts receivable and one accounts payable. Sorry, they all get aggregated into one accounts payable and one accounts receivable account for each of those things. The reason is it's just easier for us to look, see this is how much in accounts receivable and this is how much in accounts payable. Within the accounts receivable and within the accounts payable accounts, frequently in the accounting system or software that a company has, they will list out to whom they have to pay for accounts payable and who owes them money for accounts receivable. So that information does not get lost, what firm owes them money, what firm we have to pay. But for the account wise, we keep it simple. We just call it accounts receivable or accounts payable. Animal says, if it would be completely paid off, would it be an expense, downward arrow, or a liability with a downward arrow? Okay, if we completely paid it off, it would be accounts payable, liability, downward arrow, 2120. Okay, 2120, if we completely paid it off, because we got rid of that liability. When it becomes an expense, that's when we use the office supplies. Okay, so I have office supplies of 2120. If at the end of the year, I used up all the pens, the paper clips, the paper, everything, I've used it all up in the office to generate revenue, we have what we call supplies expense or office supplies expense. because we've used it all up now. We've consumed it all. So that's when it would become an expense, and it would actually be expense upward arrow because it's a cost that we've incurred, right? It's not a cost we're no longer incurring, or it's not a cost that's reducing. I understand. Yeah, no problem, Animal. I understand you're all, or a lot of you, I don't want to say all, but I imagine there is a good chunk of you that is probably really confused if you've never seen accounting before, which is totally understandable, and hopefully we'll get through this. We paid utility charges, so things like electricity, water, hydro, incurred during the year of $32.50. We paid it. So we paid it, follow the cash. Oh, I was going to do this, right? We paid it. Cash is an asset. It went down. We paid $32.50. We have an expense here. When expenses go up, we make a debit entry. Here we see. And what did we pay for? We paid utilities. Utilities expense. Expense is going up. Oopsies. Utilities expense. Expense is going up. So Amal, to continue on to kind of that question, I see your confusion here, right? So we're using utilities and it's an expense. We're using supplies. Why is it not an expense? As you'll see as we do more questions, the wages, the rent, the utilities, we usually make these entries at some point in time, right? So wages probably every 2 weeks to pay our employees, rent probably every month, utilities every month. So we kind of make this entry to pay off the expense because it is indeed a cost that we consumed to pay off our, or it is a cost we indeed incurred to generate whatever revenue it is that our company is making. You might be wondering, well, supplies, right? We used it too, it should be an expense. The reason why we don't make an entry for supplies, and this will come into chapter 3 when we talk about adjusting entries a bit more, but imagine if I was an accountant for a company you owned. Imagine if I had to make supplies expense for every item I used. I took a pen out of the cabinet, supplies expense $1, credit supplies $1, supplies expense $5 for a pack of paper I used. Credit supplies $5, right? That would be really, really redundant, and for the accountant, we would go crazy. And as accountants, we probably already are already going crazy with all these entries and all these arrows, right? So you'll see in adjusting entries, we make a kind of a lump sum entry at the end of the year to account for supplies. So I'll ask that you hold that thought until next week's lab, or I guess for you guys, it might be tomorrow's class that you learn this. Don't quote me on that, but yeah, I'll ask you to hold that thought. Does anyone have any questions on this question? Okay. Well, hopefully I went through that at a good pace. Again, I know I talk very quickly, but hopefully that was at a good pace. Okay. I'm now going to go to problem 178. Problem 178 is on page, if you bear with me momentarily, page 56 of your textbook. Relationships among finance, yeah, page 56 at the very bottom, problem 178. I just typed out the question here because the question kind of got cut off on the textbook here. So Leno Corporation reported the following amounts for assets and liabilities at the beginning and end of a recent year. So assets at the beginning, assets at the end, liabilities at the beginning, liabilities at the end. Require. Calculate Leno's net income or net loss for the year in each of the following independent situations. So I need net income or net loss. And it gives you the 4 situations. I'm not going to read you the 4 situations right now because it's pointless until we actually solve the question. But before I solve the question, there is something I need to do. In order to answer this question, you need to be aware of the fundamental relationships that exist within shareholders' equity. At this point in the course, again, at this very point, trust me, I promise you it gets more complex than this. If you're thinking, haha, shareholders' equity is so easy, it will get harder. You only need to know that shareholders' equity consists of common shares and retained earnings. Any changes to retained earnings is the result of any net income or loss that is generated, right? I said earlier, I guess I said because I can't physically see you, net income or loss it gets closed to retained earnings, as well as any dividends paid out also are affected by retained earnings. So if I own common shares in a company, that is the New York Stock Exchange or the Toronto Stock Exchange, they might pay me out a money. It is what we call dividends. And so those reduce from our retained earnings, right? So if you think about my net worth example, if I have all this money in the bank, I owe these bills, liability, my net worth, say it's $1,000. If I chose to give every one of you that attended this lab $1, I would pay out that in the form of dividends. Kim, what do you mean? I do not know what you mean by that question. I will let you rephrase if necessary. So here I say the following relationships are evident. So shareholders' equity right now consists of common shares and retained earnings. So we sum those up, we get shareholders' equity. So if I make it into kind of the changes, right, if we go all math-like, changes in shareholders' equity then should be the changes we see in common shares and the changes we see in retained earnings. Changes in retained earnings, I said net income and dividends affects retained earnings. Net income will increase retained earnings, whereas dividends will reduce from retained earnings, right? Net income, more money, yay, woohoo, increase retained earnings. I'm paying out dividends, less minus dividends. That's taking away from my retained earnings. So these relationships are going to be very, very important here. So let us solve the question. Requirement 1. Okay. I just completely lost the question. Okay. Leno declared no dividends and its common shares remain unchanged. Well, that's not fun because that's a pretty basic question then, right? No dividends, no changes to our common shares. But we don't know net income. We don't know shareholders' equity. That's probably something we need to figure out. Actually, we do need to figure out net income, but we probably need to figure out shareholders' equity to figure out, well, what in the world actually happened here. So how am I going to type this so that it makes sense? That's always the question here. So actually, you know what I'm going to do? I'm going to copy this here. Okay. Sorry, you'll just have to bear with me for a quick moment here as I figure out how to best show my work. Again, like I said, Excel is not my favorite place to do accounting, which I imagine some of you at least will agree with me. If we know assets and liabilities, we can figure out shareholders' equities. Why? Assets equals liabilities plus shareholders' equity, right? Our fundamental accounting equation. So this is equal to assets minus liabilities. Okay, how did I get this number? Let me show you. Oopsies. Oh, I hate it when it does that. Boy. Okay. Okay, I'm going to type this number in because that's the only way it will let me do my little asterisks here. And I'm going to show you that how I got that number, 231,500 minus 84,550. That's my basic accounting equation. This, assets minus liabilities equals the shareholders' equity. Again, I'm just going to punch in a number. It's 222,200. You will have to trust me on that. Not 222,2222. I don't know why that came to mind, but like I said, if you have not been aware, I do go off on my tangents. 348,100 minus 125,900. Okay. So I'm just figuring out the shareholders' equity account balances based on the information that I'm given. Now I'm going to do requirement 1, which said no dividends and common shares remain unchanged. So from the equation above right here, this is what I know. Okay, I'm going to copy that right there. That's what I know. In fact, I'm going to get rid of this and I'm going to go add net income minus dividends because all I did was merely replace this changes in retained earnings with this amount. Does anyone need me to re-explain how I got here? Just shoot a message in the chat if you do. Changes in shareholders' equity. We're talking about the year. So end of year. Yeah? Okay, Cedric. Good. Good. Good, good. Okay, so shareholders' equity, I said, at this point in time in the course, you just need to know it's comprised of common shares and retained earnings. Changes in shareholders' equity then is just equal to the changes in common shares plus the changes in retained earnings. I just added the word changes in front of everything. Right? Changes being over the course of the year from beginning to end of the year. Well, what makes up retained earnings? I had mentioned earlier that net income increases retained earnings, whereas dividends decreases retained earnings. I use the example of just think of it you as a person. Retained earnings kind of being your net worth. What's left over you have. After you have all your assets, after you pay off all your liabilities, what's left? What do you have? Assume that's your retained earnings. Say I own a small business. I made $10. I had $1 in expense. My net income is $9. Well, all of a sudden I'm $9 richer, right? My net income of $9, I add that to retained earnings. But I was so nice. I paid, $5 to 5 of my employees. That's $25. That's kind of my less dividends. That's decreased retained earnings. So you can just apply that same example to a corporation. The net income that a corporation makes, you add that to retained earnings. Whatever amount you pay out in dividends to your common shareholders, that takes away from your retained earnings. And so then I've crafted this equation here, which we see changes in shareholders' equity is equal to changes in common shares plus changes in retained earnings, which is essentially just net income minus dividend. That's this right here. Okay. So changes in shareholders' equity, that is the end of the year balance. That's the 222,200 minus no problem centric minus 146,950. That is my changes in shareholders' equity. What was my changes in common shares? 0. What was my net income? Well, that's what I'm solving for. How many dividends did I pay out? Nada. That difference, 75,250. Final answer. If we're playing, I believe that's Who Wants to Be a Millionaire, right? Okay, so you see when we have this equation, the question all of a sudden is not hard. It's algebra. Now, I didn't show you how you do this algebra, but I'm assuming you know how to do the algebra. I really hope you know how to do the algebra. I'm going to copy the same equation again, and we're gonna keep going. Okay, I'm going to go back, and I'll come back to this. Lionel declared no dividends and issued additional common shares for $12,000 cash. No dividends, more common shares. Okay, remember that, 12,000. Changes in shareholders' equity, that doesn't change. That's still my 222,200 minus 146,950, which we know by above is actually equal to that $75,250, but I will keep adding the algebra there for suspense. Changes in common share, we issued an additional 12,000. When we issue common shares, that's an increase to common shares. Okay, when we cancel or repurchase common shares, that's a decrease. Okay, issue is more common. That's chapter 10. I'm getting ahead of myself. Dividends, I believe we said no, net income. Net income is what we're trying to find, or net loss. It could be net loss, never know. Dividends, I believe, was 0. Sorry, I'll come back to that. Yeah, it was 0. Okay, do your algebra. This is 75,250 minus the 12,000 on that side. Again, I'm not going to show that work. I imagine that should be okay. If it's not, let me know, I guess, and I will definitely explain that. And the net income then in this situation is 63,250. So I hope you can see so far, just from what we've done, accounting is a lot about relationships between accounts. These are fundamentals. What we do in this lab is going to be so fundamental for the rest of the course. You have no idea. If you've taken accounting, you know, but if you haven't, you do know. What's the question number? It's P178B on page 56 of your textbook. Okay, Felipe? P1-78B from page 56 of your textbook. Like I said, these accounting relationships are so fundamental, they're going to form the base of the rest of the course. You need to master these relationships: assets, liabilities, shareholders' equity, revenue, expenses, net income, dividends, common shares, ASAP. Because 1, this course is a month, so you really don't have a lot of time. And 2, this will come back over and over and over and over again. Sound like a broken record. I know if we were in class, this is usually when I see a bunch of eye rolls, like, yeah, we get it. but I feel like it's still my job to nag and repeat. Lino declared dividends totaling $8,000 and its common shares remain unchanged. So what am I going to do? Copy this same question. Obviously, if you're writing this out, you don't have to copy this question. I do wonder actually how many people are at home and actually at a desk and writing this out, or if they're on their bed and lying down and resting and watching, I think America's Got Talent just started, which I have recorded. And see, now I'm off on my tangent. No common shares that remained unchanged and dividends of $8,000. Changes in common shares, 12. No change. Funny because I just said that. I'm going to add net income, and we paid out dividends of $8,000. And so my net income is that algebraic difference, and that is $83,250. I probably should have put a dollar sign in front of there if I'm being really picky, but that being said, I've never seen anyone take off a mark for not putting a dollar sign. Just as a heads up. Question 4, I'm going to copy that same thing. Leno declared dividends totaling $11,000 and issued additional common shares for $15,000. Look at this. We're getting really fancy. We got 2 things going on now. Woohoo, right? Dividends $11,000, common shares $15,000. I am going to copy this changes again, or again. Tomato, tomato, potato, potato, right? Changes in common shares was 15,000. Trying to figure out what net income is, and I got 11,000 here for dividends. Let me just confirm. 15 common shares, 11 dividend. Very good. 4,000 difference there. So my net income then is 71,250. And that completes this question. So again, hopefully you see that this question itself actually wasn't very hard if you knew this fundamental equation. Okay. Does anyone have any questions? Now would be the time to ask them. Anyone need me to repeat anything? Re-show you anything? Now would be the time to speak or forever hold your peace. Thank you, Kevin. I appreciate that. Okie dokie. Can you show us the question? For sure. That is the question. Again, I cannot stress enough, you got to do a ton of questions. That's the only way to do well in this course. If you just do kind of the lab questions and that's it, to be very blunt, that is not enough. Are these the types of questions we will be getting in our exams or more complex? I don't write the exam. I don't see the exam. I don't know what's on the exam. Well, I have an idea of what chapters are on the exam, but I have no say over the exam, is my full disclosure. From my past experience, I would say these questions are very, very, very easy. And these would be multiple choice questions, if anything. I don't see this being a really long answer question. Your long answer questions will be harder than this. They'll be more complex. A lot of you probably are at home being like, well, Calvin, you're an idiot for saying these are easy, right? Like, we're super confused. Again, as you do more of these questions, you will see that this is the easy part. I promise you that. They will get harder. This is nothing. And I mean, I also don't want to seem like I'm scaring you away from the entire course either. It's not a bad course if you put in the work. And NOHA is fantastic. So if you put in the work, go to class, come to my labs. I would appreciate that anyways if you came to my labs, but I think you'll do fine. That being said, with the whole COVID situation, it also adds its challenges in itself. Thanks for, oh, sorry. Don't mean to crush people's dreams. Gotta put in work though. Sorry. Now I lost my train of thought. What was I saying? I'm sure it'll come back to me. I go off on many tangents. So we have, oh yes, the whole electronic exam thing, not my cup of tea. It's okay for written courses. Not my cup of tea for math and accounting courses. I am old school. You can call me that if you will. I still like the pen and paper, um, especially for math courses. Thank you for reminding me that. Anyways, problem 272B. So we're going to go back to making some journal entries. Hopefully we've had a little bit of time to let it sink in. You're now masters at making journal entries. Problem 272B is on page 123 of the textbook. Again, this is problem 272B, page 123 of the textbook. When in doubt, you always see it at the bottom of my tabs here. I'll have kind of an Excel workbook like this every single time, so you can refer to this. Okay, Mulberry, sounds like Burberry. Mulberry Services sells electronic data processing services to firms too small to own their own computing equipment. Mulberry had the following accounts and account balances as of January 1st, 2018. This is the beginning of the year. You have accounts payable, accounts receivable, common shares, cash, interest payable, notes payable, prepaid rent, and retained earnings. Let's go through these accounts first and help and try to classify these so you know what they are. Accounts payable, current liability. Accounts receivable, current asset. Common shares, that's a shareholder's equity account. Cash, it's our asset. Interest payable, current liability. Notes payable, note how it says long-term liability. Hopefully you see a pattern. When you see the word payable, liability, that's what it means. So those two words should become synonymous in your head. Whenever you see payable, you should be thinking a hammer is smacking you and saying that's a liability. Prepaid rent, short-term. Again, or not again, but here's another kind of synonymous term. Whenever we see prepaid, prepaid is a current asset. Prepaid rent means we paid the rent expense in advance. You cannot expense it until you've actually used that month's rent. So that's why we keep it as a current asset. So for instance, if I was renting one of your houses, or if I was renting a room in your house, I paid you 2 years rent in advance. From right now, June 1st, what year are we in? 2020? Wow, I should really know that. June 1st, 2020 to June 1st, 2022, I paid you 2 years rent. You can't claim you've incurred, or I can't claim I've incurred rent expense of whatever that amount is for 2 years because I haven't lived in your house yet for 2 years. Month by month, I will reduce that current asset. I will draw it down. Asset goes down, credit entry. I will reduce that prepaid rent, and I will make it a rent expense. This goes with a lot of, I believe it's in chapter 1 or chapter 2. We have a principle called the matching principle, which states that, revenues and expenses have to be matched to each other in the period that they're earned, right? So I can't, all of a sudden have $1 million in expenses for expenses I'm expected to incur over the next 10 years and put that on my books to reduce net income just so I can pay less tax, right? That would be unethical. So that's why we have that matching principle. So the timing needs to coincide is essentially what I'm saying. That was a really long tangent. And we have retained earnings, which we know is a part of shareholders' equity, which I said will get more complex. I promise you that. So during 2018, the following transactions have occurred. The event as described below are an aggregation. So you have A through J. We are only responsible for requirement 2. So that's analyzing the transaction and journalizing as appropriate. So what does that mean? We're going to do the same thing we did in the last question we did with all the journal entries. I'm going to do the journal entries. I'm going to put that thing in the on the side, asset goes up, asset goes down. And then that's how we're going to solve the question. Again, if the question does not tell you to analyze, you do not need to put these A up, shareholders equity up in the brackets. I'm merely doing that one because the question asks. But even if the question didn't ask, I would do that. I just want to show you what the accounts are and where they go. What one student actually told me once before was actually helpful. They made a running list of all the different accounts that fall into assets, liability, shareholders equity, expenses, and revenues. And so they kind of referred back to that. So if they saw, accounts receivable, you look to your list. Oh, it's a current asset, so it's something easy like that you can refer to as you're doing more problems. Okay, enough of me. During 2018, Mulberry sold 690,000 of computing services, all on credit. I'm selling you a service, that's a revenue. of 690,000, all on credit. That means cash was not received. So I can't use my follow the cash tactic here, unfortunately. Just bear with me for a quick moment. I'm just going to copy this little chart thing back over here so you can see it. And I have my little up and down arrows too, so that's nice. Sorry, bear with me here. Again, I prefer doing this all on a whiteboard, but times are a-changing. Okay, sold services. So I'm going to start with revenue. I know it's revenue. Revenue is going up, right? I sold all these services, $690,000. Revenue goes up. I make a credit entry. Make sure you indent. Service revenue. How much was it? It was $690,000. This should also be $690,000. I need these all to be formatted properly, so you'll see me do a lot of this, formatting stuff on the side as I talk here. What do I debit? I sold these services on credit. Cash was not received. So on credit means accounts receivable. Asset going up. Going up. Right? I'm expected to receive this money at some point in time. I sure hope. He said hopefully. So that's an asset that goes up. I'm expecting to receive it within a year. It's a current asset. I don't know any company that would say, I'm going to fix your computer now. You pay me, in 10 years from now, right? No one's saying that. It's a current asset. Accounts receivables are always current assets. The account receivable account actually is a very unique account. We'll get a little bit more in depth into it. I believe it's either chapter 4 or 5. I think it's chapter 5 because chapter 4 is cash. But again, it's simple for now. It'll get more complex. I promise you that. I've been told I scare people away often, and I'm sorry if I'm doing that now, but I'm fair warning you for what you are to expect to see. Mulberry collected $570,000 from the credit sales in transaction A. So I got some of that money. Very good. What did I? So here it doesn't say I got cash, but obviously it's cash, right? What else can we collect? So 570 in transaction A, and an additional 129,000 from the accounts receivable outstanding at the beginning of the year. So at the beginning of the year on January 1st, we have 130 outstanding. We collected 129,000 of it. So we're going to factor that in. So it's 570 plus 129 that we collected from accounts receivable. So I'm going to show you rather. I was going to say punch that calculation in, not actually punch a physical person. There is no one here other than a computer. Debit, what am I debiting? I got cash. Asset goes up, right? By this amount, whatever that is. Oops. One too many zeros. We're not making that much money. What's going down? The accounts receivable is going down. Not, now, be very, very careful here. Don't think I'm going to do revenue. Don't think, I sold some more services, gave more revenue. No, no, no. Why no, no, no? We already accounted for that revenue here. For the 507, I'm going to bring this back in a minute. For the 570,000 from transaction A, we accounted for that revenue in this entry right here. You cannot book revenue again because we already accounted for it. What did we put that amount temporarily in until we got cash in this account called accounts receivable? Then the accounts receivable is going down because we got the cash for it. So revenue is no longer a factor here because we've already recorded it. You don't want to record it twice. That is not good. As for the other 129,000, that amount was already in accounts receivable. Some accountant last year would have already made the sales revenue entry. So we are not expected to make that here. Again, stop me if you have any questions at any point in time. I forgot to ask, did you guys want me to take a 5 to 10 minute kind of pause after that last question? But we have only been going at it for an hour, so I assumed not. Can you explain this again, please? Yes, I can. I hope you're all okay with no break. If you're not, someone speak now in caps font, maybe. Otherwise, I'll just keep chugging along. Yeah, okay. If it's a longer day, I for sure will give you a break. I don't want to intrigue you with accounting for too long. I like how you use that word intrigue. Okay, can you explain this again? Yes, okay. So We collected $570,000 from credit sales in transaction A and an additional $120,000 from accounts receivable. So the first part of the sentence is a little bit misleading, right? It said from credit sales. But what does that mean? Well, we made an entry from these credit sales to accounts receivable anyway. So this amount is already in accounts receivable. So the 570 and the 129 added together is the 699. I received the cash for it finally. Woohoo, yay me, right? That's great. But the accounts receivable is what's going to go down. These are people that I have previously offered my services to. I've already made an entry recording the revenue that I got from this service. If I was to put revenue here again, all of a sudden I have two revenue. I'm recording this twice. I don't want to record revenue twice. You should only record it once. And so it's accounts receivable and not service revenue because we already have previously recorded the service revenue. We just didn't receive the cash at the time. So we recorded an accounts receivable until we received cash, at which point now we're reducing the accounts receivable because the amount that people were owing us is now down because we've actually received cash for it, which is great. Someone asked, okay, I did that. Can you explain the part B concept? Yeah, so that 129,000, it told us it was from accounts receivable outstanding at the beginning of the year. So at the beginning of the year, it says we have 130,000. This means that last year sometime we offered services to someone or multiple people. They didn't pay us in cash yet. That's fine. We put it in accounts receivable. These are amounts that customers owe us that we haven't received in cash yet. Totally okay, right? 130,000. But now this year we've received it already. Great, right? And so we're going to reduce the accounts receivable because these people here already paid us now. So we're going to reduce that accounts receivable by 129,000. Why? Because we have now received $129,000 in cash, which is great. I combine these entries in two. As William here said, could you do these in two transactions or is it better to consolidate? You could do it in two transactions. It is not a problem. You will not be marked wrong. If you are, you shouldn't be, so you need to fix that. Doing two transactions is totally fine. Nothing wrong with that. But for me, I like to consolidate because doing two transactions is a lot of work. In this case, because the accounts are the same, I have no problem with it. As we move along in the course, you'll see entries that have multiple line items, like not just two, but like 3 or 4 or 5. At that point, sometimes I like to separate into two transactions. Because I find it difficult just to keep it all in one, just to help me understand. Whatever helps you best, that's what you can do. Okay. Okay. So for part C, sorry, what about 1,000? What do you mean? What? Oh, the 1,000 as in the 130 here and how we only got 129? Yeah. So maybe that person that owes us 1,000 hasn't paid us yet. Maybe they will pay us in a month or two. Okay, totally fine. We haven't received it yet, so we're going to keep it at accounts receivable. Okay. Now, you really like me going off on tangents by asking these questions. In chapter 5, we'll have what we call allowance for doubtful accounts. This is when someone owes you money, but they don't pay you, so that is not good. But I will save that conversation for chapter 5. I won't intrigue you with that yet. Okay, I'm going to move on now. Mulberry paid the interest payable of $8,000. We paid it. We paid it means we have a cash outflow. So I'm going to credit cash, $5,000. Now, here's where accounting gets funky. We previously set up an account called interest payable right here. Can you see this? Interest payable for $8,000. This means the amount of interest that we need to pay, but which we have not yet paid, is $8,000. At this point in time, I am now paying it. So the entry that I'm going to debit here is interest payable. Liability is going down. Asset is going down here. Oops, 8,000. Yeah, sorry. Thank you for that. Okay, I'm going to repeat that again because I imagine at least one of you has to be confused with this. Because someone always is. It's not you. Someone is always confused with this, especially if you're new to accounting. Mulberry paid the interest payable of $8,000. Paid, cash outflow, asset goes down, we make a credit entry. Hopefully I have tried to ingrain this in your head by now. Hopefully you're getting it. Okay, if not, we have a few more questions to go to keep it ingrained. But we're paying the interest payable. Interest payable, by definition, is a liability. It's an obligation that we have. It's money that we owe, but we have not yet paid. It's payable. It's to be paid, but not yet paid. You see it? I hope you see that differentiation there. Interest payable being interest that we owe to a bank. We paid the interest payable, so now we no longer have this liability, so the liability can come down. That's why we're debiting interest payable. Previously, the accountant, when they set up this entry, they would have debited interest expense and credited, I hope that's a word, credited interest payable. Okay? Previously, the accountant would have made this entry when the interest was due. When the interest was due, they'd said, okay, we have a liability. You know what? That's going up here. Okay, oopsies. We have a liability that's going up here. We have an expense here that's going up. But we have yet to pay this yet. So this interest payable is kind of like a temporary holding account that we have here until we pay it off. Here, we're now paying it off. We're getting rid of the interest payable and we're getting rid of the cash. The interest expense was already recorded previously. So this is prior entry. Make sense? Some degree, hopefully. Okay. I'm gonna chug along. If you need me to come back, you let me know. D, wages of $379,000 were paid in cash. So we've seen this entry before already. Again, credit cash. Cash is an asset. We paid it. Cash went down. How much did it go down by? The amount of salaries of $379,000. What are we paying for? We're paying wages. This is wages expense. This is an expense, and this amount is going up. Now you might be thinking, well, wait a minute. You just made an entry for payable. Why is this not wages payable? Well, let's look. Did we set up a wages payable account? No, we didn't. So there is no payable yet. The liability has not yet been established. If we had established that liability already, there would be a liability already on our books that we need to reduce. And so this would be wages payable, L down arrow. But we didn't set up a liability. On the day we needed to pay those expenses, we paid them in cash. Right then and there, we're done with our lives. This entry was different because on the day that we knew we had to pay interest, we didn't pay it yet. We have the interest expense. We knew we had to pay the interest, but we didn't pay it yet, so we set up a liability on our books called interest payable. Then we paid it, interest payable. Now we can get rid of this liability going down here. And how do we get rid of it? We paid cash. And you're all silent. I mean, you all have been always silent because I feel like I'm just talking to myself. But you're all really silent. Okay, I'm going to keep chugging along then. Repairs and maintenance expense of $9,000 were incurred and paid. No, we get it? Perfect. If anyone doesn't get it, let me know. Repairs and maintenance of $9,000 were incurred and paid. Okay, incurred and paid. I love going to cash first. 1, 2, 3, 4, 5. Credit cash. Oopsies, asset goes down. Repairs and maintenance expense of $9,000. $9,000. Oh, I haven't said it a lot, this question, but remember, you see how our debits always equal our credits. The amounts do not just magically appear or disappear. What was this for? It was for repairs and maintenance. I'm just going to abbreviate to EXP dot because the line is kind of running out. Expense, oopsies, expense up. I guess I have to expand it anyways, hey? Okay. So sorry, this here, not a part of the question, okay? You did not need to write this thing that I've highlighted. That was just me explaining my point in a very long-winded way. Okay. F. Okay, this is a funky one. The prepaid rent at the beginning of the year was used in 2018. In addition, 28,000 of computer rental costs were incurred and paid. There is no prepaid rent or rent payable at year end. That's all they tell you. Okay, so what do they tell me? So there's a lot of things going on. I have the usage of prepaid rent, and I know we have 28,000 of rental costs that I incurred and I paid. So there's more than two things going on here. I'm going to take it one thing at a time. Like I always say, follow the cash. 28,000 of computer rental costs incurred and paid. So that's a cash outflow. What do we know about cash outflow? Not delete the line. Cash outflow, we credit, right? Asset goes down. I left an extra line there for a reason. Just if you bear with me. Cash outflow of 28,000 for those computer rental costs. You know what? I'm gonna do, no, okay, no, never mind, sorry. There's a reason why I'm hesitating, but I will tell you that in a moment. Prepaid rent at the beginning of the year was used. So prepaid rent here, 96,000. All of that amount that we prepaid in advance, we now used. So we don't have it anymore. So prepaid rent, like I said earlier, when we see the word prepaid, you should be thinking current asset. We used it all up. So we no longer have that asset. That asset went down. So we're going to credit that. Prepaid rent asset going down. If I can highlight this arrow properly. Okay, 96,000. We used that all up. None of it is left. What did we pay this cash for? And what did we use this prepaid rent for? Well, rent expense. The sum of these two amounts. Uh, 96 and 28. I will get to your question momentarily, Felipe. I just want to finish this for a quick second here. I need an up arrow here. Okay, so someone asked me earlier, I don't remember who, but someone asked me, can we separate these transactions, right? For one of the earlier ones. For sure you can. You could have done, instead of this, you could have done, again, everything I write off to the side here, like column F and onwards, you do not need to write if you don't want to. You could have done this instead, 96,000, and then you could have done this, and then you could have done this, and then this, and then this. This equals this. Both are okay. Okay? You do you. You do whatever makes it easier for you. In fact, honestly, when you're first learning accounting, this is probably easier. I'm just so used to doing this, I jumped to that, so I apologize for jumping to that, but this is probably the easier one to do because you're almost treating it as two separate events. The first event, I paid cash for this rental amount, and this other event is I'm using up my prepaid rent for rent expense. Now, Felipe here asked, when you say already used, you mean that we already paid that amount? Yes, correct. So when I say prepaid rent, I already paid this amount sometime before. So long ago, I said, hey, I'm giving you $96,000 for the rental equipment that I'm going to use from June to December. December rolls along. I have no more of that prepaid rent. Why? Because I used it up, right? As the months go by, I used up my prepaid rent to actually rent the equipment. So it becomes used. So the amount that I initially had in prepaid rent, I no longer have anymore because I used it up as we went along. If I had prepaid right now, June 1st, 2020, until June 1st, 2021, and at December 31st, I wanted to make an entry. In fact, I have to make an entry because it's year end, which will be adjusting entries, which is the next chapter. But at December 31st, I make an entry. half of the amount then of my prepaid rent would be used, right? I prepaid June 1st, 2020 to June 1st, 2021. At December 31st, 2020, actually, it would be more than half, hey? It'd be 7 months. 7 months of that prepaid rent, that's all used up, that's gone. I would make an entry reducing that prepaid rent via a credit because my asset's going down, and I would put a debit to rent expense, expenses going up. G. Mulberry purchased computer paper for $13,000 cash in late December. None of the paper was used by year end. So I purchased paper, computer paper, for $13,000 cash. None of it was used. Follow the cash. What did I do to purchase this? Well, I had to pay out some money in cash for $13,000. So this here, let's do or. Let's do this, let's bold this, let's do this, maybe we'll do some italics, okay. Okay, what am I debiting? It's computer paper. Here's the, like I said, here's where accounting gets kind of funky. You could put computer paper, but the more appropriate term is probably office supplies or just supplies, because I think I alluded to it a little bit earlier. If I had to track every single pen, every single whiteout, every piece of loose leaf that I used in a company, accountants would go crazy. We really would. So we clump it into office supplies. And this is one of the more common ones that you'll see clumped, and you'll see it over and over again as well. So things like pens, pencils, paper clips, loose leaf, computer paper, all this stuff, we clump it into office supplies. Just because the effort it'll take to calculate, you know, how many pieces of loose leaf each person used or the company used would be a little bit too intense for the accountant. Alrighty. H, advertising expense of $26,000 was incurred and paid. Oh, I forgot to do this. Sorry. Okay, guys. So this asset's going down, right? And here we have our asset going up. Where is my up arrow? Right? Because I've used the cash to purchase more office supplies. I haven't been referring back to this yellow highlighted area here, but I hope you can see that these relationships are still holding true. I'm not referring back to them, but they are true, and you can use it to check your work to make sure that your entry is in balance. Okay, advertising expense, right? So this is as simple as that. Advertising expense is going up, and that was $26,000. So you'll see some of these entries, they're just going to be very straightforward and become very mundane if they're not mundane yet by now. I, income tax expense of $10,300 was incurred and paid in 2018. Incurred and paid, there's an outflow of cash of $10,300. The other side of the entry has to equal that same amount. What am I paying? Income tax expense. Expense goes up. I'll close my bracket. The expense entries are usually quite simple. And lastly, J, interest of $5,000 was paid on the long-term loan. Very good question, Miguel. Why is income tax not a liability? The key word here is income tax of $10,300 was incurred and paid. That paid is a key word. If it's paid and there is no liability already established, you're making it an expense. But because, if it's paid and there's no liability already established, it's an expense. If it just said income tax of $10,300 was incurred and not yet paid, then this becomes income tax payable, and this is liability goes up. But because it's paid, it's an expense. Okay, interest of $5,000 was paid. So again, another cash outflow. Paid here of $5,000. Beautiful, and it's interest. So here, this is a good example. to kind of build on Miguel's question here, is this interest expense or interest payable? Comment now. Expense. Do people agree? 2 people? I'll go with 2 people. Oh, 3. No, 4 people. 3 people. You can't comment twice, Tomer. That doesn't work. Okay, I'm just kidding. Yes, it is an expense. Why is it an expense? Because, I see. First one was just to me. It is an expense because there is no more payable, right? We set up a payable, a liability of $8,000. We set up a payable of $8,000, but we used it all up. We had that liability. We got rid of that liability. We paid out all the $8,000. We got rid of that liability. Now, if I'm paying it, it's just clearly an expense. I have no more liability that I previously set up to get rid of it. So, Animal, does that answer your question? There is no payable left. If there was a payable, I'd have to reduce the liability. But because there's no payable, there's no liability to reduce. I never set up that obligation to begin with. And so I incurred it and paid it on the same day, expense it out, move on. So the interest payable or an income tax payable or a rent payable, I call it, and this is by no means an official term, I call it like a holding account, right? Whenever we have set up that obligation, that liability, but I haven't paid it yet, I'm calling it a payable. But until I pay it, it's not going to disappear. So for example, on the day I get my Visa bill, I set up a liability for myself, right? Because I haven't paid it yet, but I know it's an amount that's payable. Would it have been a liability if there was no Part C? Yes, if there was no Part C, I never got rid of that liability. So don't write this down, just listen. If there was no Part C, this would have been interest payable liability down for $5,000 because I previously set up that liability. Now I'm reducing it because I paid it off. But because we had Part C, we already got rid of that liability. So there is no liability to get rid of. There was no liability we set up to begin with. Okay? Okie dokie. Okay, good. But you still had 1,000 left over. Does that not matter? What we had 1,000 left over was accounts receivable. That has nothing to do with interest. That is its own kind of beast. Yeah. Okay. So let's take like a 5-minute break. We'll reconvene at 7:44 because that's the time on my clock. Anyways, I'm going to charge my laptop. And then we'll tackle the last